Hello, dear members of Market Feed. Hi, good evening. Good evening, all of you. Yes, I can see your messages and comments now. Manoji Das, Bijomon Baby. Hi, good evening, all of you. Hi, hope you're having a great Saturday, having a good time. So thank you for being here. Welcoming you all to another level up session conducted by Market Feed. So we've been conducting such level up sessions regularly now, where we are focusing on upskilling you. So we've had sessions on intraday option selling. We've had sessions regarding long-term investment in mutual funds. We had sessions from experts from the industry coming here and talking to you. Yeah. Hi, good evening. Yes. So we are super happy today and super proud at the same time because we are bringing someone very special to all of you today. So today it's all going to be investing in ETFs or exchange traded funds. So I know all of us as a community, we have always talked about ETF. I haven't done a video on ETF, I know that, but again, we all know ETF as an asset class, and as I wrote in the message in Discord, ETF is a super awesome asset class that you can have as a strong pillar in your long-term investment portfolio, right? So today it's all going to be ETFs, and I'm sure you're all excited about it. And from Market Feed side, it is our constant endeavor to bring experts from the industry to you so that you can keep interacting with these experts and you can be the best at your investing and trading game. And that is why we are going to do it. So Sarthak sent us asking, please talk about how to choose ETF in the same category. We'll be doing that. We'll be talking everything about exchange traded funds, and we have an expert talking about that today. So I won't be taking much time because it's going to be a 1 hour session where the first half an hour will be a presentation by the expert and the second half an hour will be Q&A. So please feel free to ask your questions in the chat, and Vibin from Funfolio will be the host, and we will be asking your question, curating the question and presenting the question to our special guest today. And speaking about our special guest, who is the speaker today, he is Mr. Umesh Kumar Daila, who is the head of ETF sales at Mirae Asset Management Company. I know we all know Mirae Asset Management Company, and we are all in, and that's the company that we are all invested into, right? I'm sure all of us who are investing into SIPs has at least one fund which is from Mirae Asset, and we have Mr. Umesh Kumar Daila, who's the expert and who is heading the sales of ETF for Mirae Asset. And he comes in with 15 years of experience in mutual fund, and he has worked with IDBI Bank and also Tata AMC before this. So I'm not taking any more time. Mr. Umesh Kumar Daila, so super happy to invite you to speak to our great community here at Market Feed. It's my pleasure inviting you. Thanks a lot for being a part.
Thank you. Thank you, Sharik. Thank you for having me here. Thanks, everyone. And I'm really excited more than you to present this different side of investing, which is now taking a shape in a country like India. And I'll be talking about the global trends a little bit, the trends in India. And obviously that there was one question, how to select ETF and what things to be considered while selecting an ETF. I think that's more important because the way ETFs are moving up, there are a few concerns, there are a few things which we need to be taken care. So surely we'll talk about that also. So if you're okay, then
your voice is breaking.
Yeah.
So when he is certifying that, probably Vipin, you can give a brief on what exactly is happening and how you want to host the whole session.
Yes, yeah. So again, good evening, everyone. So we are moving to another session, as Sharik already mentioned. So today we actually gonna talk about ETF. So I'm actually really excited about it because I can see that more than close to 500 participants already there regarding ETF. That itself showing that as a community we have some interest towards the ETF, right? And we already promoting a passive investment, right? We say that we do trading so that we can also have a passive investment kind of thing. So on that side, maybe the term itself, passive investment term itself, have derived from this ETF, right? It is actually the passive investment, right? And if you're looking into global aspects, right, around 60% of global volume is trading on ETF. But if you're looking into India, it is not that much percentage. So last 2 to 3 years, if you're looking into, or maybe say for the 5 years, in India also we are seeing some traction on ETF, right? And even government coming forward and taking some interest to increase the AUM towards the ETF, right? So a lot of action we can see on the ETF side, and even towards, if you're looking into the return part as well, we are seeing that index fund is also competing with the active management funds, maybe at least on the large cap front itself, right? So a lot of things has to be discussed. Maybe Umesh will be the right person to address everything, right? So I think it's very happy for me to introduce Umesh here, right? Umesh Kumar. So over to you, Umesh. You can start it forward. So I'll just make a note of it. So we will be conducting a brief about ETF in the first session. Maybe 15 to half an hour will be a presentation, which is on the basically what are the ETF and how it works, things like that. And after that, we'll be opening for a Q&A so that everyone can ask their questions, and Umesh will be addressing all the questions, right? Okay. So over to you, Umesh. Yeah, you can take it forward. Umesh, I'm still not audible. I think it's from your earphone or something. Still not audible, Umesh. Something. Not audible. Maybe can you rejoin or something? Yeah, please. So maybe in the comment section, if you guys can already say, maybe someone who already invested into ETF, you guys can name few of the ETF which you have invested, because we have several ETF on the market, right? So I would be happy to see that how many of you invested in different ETF. Yeah, I can see a name, MF fan, Mirae fan, maybe for as a okay, from Sharik. Oh, I didn't see that come. Okay, so everyone know about Mirae Fan ETF, I guess. At least it's yeah. I can see a name, Nifty piece from Midun Harish. Yeah, can see. I hope I will be seeing a lot of Nifty piece mostly, right? So we'll see how much Nifty piece, Junior piece. Yes, Nippon Nifty piece. It's the best platform to manage. Junior piece, yeah, I can see Junior piece over there. UTI Nifty funds are there, right? Yeah, some mid cap index also I can see, right? Motilal mid cap fund was also there, right? Kotak is there, Gold Bees is there, yeah. So you can also see that small case ETFs are there. Good. Okay, yeah. Yes. Abdul, seems Umesh already joined. Can you just make him to co-host?
Okay.
CDFC ETF. You can see a lot of ETF name here, right? Okay. So anyone know who enjoys the major, say, AUM in ETF? Which company hold the major AUM in ETF? Any idea?
Am I audible now?
Yes, Umesh, it's audible now.
Okay.
Yeah. So I was just asking a question: who enjoys the highest AUM in ETF? So I can see, yeah, different names. So yeah, someone mentioned SBI. Yeah, it's actually SBI, right, Umesh?
Yeah, basically, so there is because of EPFO, because still the ETF space is being taken care and taken over by EPFO primarily. and the EPFO money goes to SBI, UTI, and that 2-3 names where they invest into Nifty 50 and Sensex ETF. So that's why.
So that's the reason government support is there. Maybe that's the main reason.
Yeah. So that's how it is. So I'll quickly share. Just allow me a moment.
So
Yes.
one sec. So just setting the mood of the room. So women also, if you can take into account, and Mr. Umesh as well. So even there are people in the room who doesn't even understand what AUM is. So if you can tell asset under management rather than AUM, it can be helpful. And also when you said you said EPFO. So if you could have said employee pension fund organization, that again could have been more helpful. So just, I mean, it would be great if you can keep in mind that there are a lot of beginners in the room. So keeping things super simple and basic, that would be super helpful.
Sure. Thank you. So yeah, as I said, I'll start now. So the idea is to quickly brief you about the ETF, the basics of ETF, how ETF works, what actually ETF is, and as Sharik mentioned, that few of the people you must not be aware much about the ETF. So I'll try to address those jargons also, which can help you in terms of understanding ETFs more. So I'll talk about the future of investing. The future of investing is obviously the ETF. I will talk about ETF more, how it works. So what is ETF? ETF is nothing. ETF is basically a combination which gives you, tradability like a stock which you trade, like you have been doing your trading into stocks in your day in day out. On similar ways, you can do the similar things on ETF. Also it gives you a structure like a mutual fund, because it's a you can say professionally managed mutual fund based on ETF. So it's a combination of stock freedom of the way you trade in stock, also the professional management and the structure like a mutual fund. That's basically the difference. So now if we look at there are similarities, there are differences also between say ETF and MF. Because why we're comparing ETF and MF? Because MF is something which we investors and us as an investor also we have been doing more from a investment perspective. So yeah, so I'll just talk about, there are as I said, similarities like portfolio construction. There can be broad strategy, sector, theme based, and professional management. These are the, you can say, similarity between ETF and MF. But there are differences also which we talk about. A lower cost trades on exchange. This replicate the benchmark, which gives you the beta exposure, and obviously you can watch the portfolio on a daily basis. That also gives you that freedom where you can you can have control over the overall the portfolio, how the portfolio moves in, and what sort of constraints are there in the portfolio. That's also can be taken. So
Sorry to interrupt. Can you please disable that annotation if possible?
no, I haven't done anything.
No, an annotation you can stop it so that.
Just a moment, I'll do it.
Yeah.
Yeah. Is it okay now?
Yeah. Okay.
No, it's not happening this time. There's no option to stop.
You can see on the settings of Zoom. It's okay. You can continue. I'll take care of that.
Yeah, please. That will be great. Yeah. So there are differences, like as I talk about, there are similarities, there are differences in ETF and mutual fund. We're starting from tradability, because trading, you can do trading in exchange traded fund, which you cannot do into mutual fund, because mutual fund is based on a day and NAV, whereas in ETF you can buy on a live NAV, where the way you buy and sell your stocks, right? It's a transaction avenue. If you look at, you can buy one unit, you can buy one unit of ETF on exchange, which comes with us, say 50 rupees, 10 rupees, and all, whatever the price is. And also in terms of MF or mutual fund, units can be purchased directly with the AMC, unlike ETF where you can go to the exchange and buy and sell. The transaction price, obviously, it can be bought and sold on a INAV basis. So INAV, what is INAV? INAV is basically the naked portfolio value of that ETF. Say if you talk about Nifty 50, so Nifty 50 have been created, the ETF is created from Nifty 50 index with a similar weightage. So the underlying securities on the basis of their live pricing, there is a price comes out which we call INAV, which is the indicative net asset value. And on basis of that INAV, you can buy and sell your ETF on the exchange, depending upon what sort of market maker is there and what sort of objectives pricing are there. The portfolio, as I said, it replicates the portfolio of underlying exchange, underlying index, as compared to mutual fund, where fund manager has the leeway to go out of the index and can buy other stocks from other indices also. So the stated objective of exchange traded fund and mutual funds is different. The mutual funds objective is to beat the benchmark or to outperform the benchmark, whereas the objective of exchange traded fund is to replicate the benchmark. The way the benchmark moves, the exchange traded fund should also move in a similar fashion. So that these are again some of the differences and all. Now let's talk about that. Now there is one more concept here, or investment avenue here, which we call the index fund. So there is an ETF, there is a mutual fund, now there is an index fund. There are a few similarities between ETF and index fund as compared to MF mutual fund, which is the ETF and index fund both replicates or mirror the benchmark. The way ETF does, similarly index also does. In case of mutual fund, it doesn't, because it incorporates fund manager's view also. As I said, fund manager can go out of the index and can buy other stocks from other indices also. The return, so return in case of ETF and index fund will be similar to the underlying benchmark, whereas in case of mutual fund, that seeks to outperform the market, because for that they charge higher cost also. That's where the costing part in mutual fund is little high, very high as compared to ETF, and the index fund is also little on the higher side as compared to ETF. The basic difference between index fund also, where the index fund also become part of mutual fund structure, which is the buy and sell price. As I said, in ETF, you can buy and sell on a live basis, on a market live basis. But in case of index fund as well as mutual fund, you will be buying the units on a day-end basis, on a day-end NAV basis. The intraday returns, obviously, ETF replicates index or mutual fund. You can't get trades on exchange. You cannot trade ETF, index fund, and mutual fund on exchanges, where ETF can be traded on NSE, BSE, or other exchanges where the ETF is listed. Obviously, for ETF, since it's a product which can be traded on exchange, so investor needs a demat account for ETF, whereas for index fund and mutual fund, the demat account is not required. These are few basic differences. As I said, mutual ETF, which is exchange traded fund, is a very cheaper, lower cost as compared to index fund as well as mutual fund. You can get a normal Nifty 50 based or a large cap based ETF in the range of 8 basis point to 10 basis point of TER. TER is a total expense ratio, which is being charged to the investor on an annual basis. Whereas similarly, if you buy mutual fund, the mutual fund expense ratio is somewhere around ranges between 2.25 to 2.5%. So that's a huge difference in terms of costing. Performance, as I said, ETF replicates the benchmark. Mutual fund has to outperform. That's where the stated objective is. Liquidity is something which is really important. And in ETF nowadays, you see more and more liquidity coming in, because the the authorized participants, which I'll talk about later, are becoming more and more stronger. That's why the liquidity part is taken care. The transparency, obviously, it is more transparent than mutual fund and index fund, because you can see the underlying portfolio on a daily basis, on a real-time basis. Obviously, it reduces the market risk also. right? So ETF can be, the investors are trading and investors are taking ETF on both the platforms. Some of the investors are keeping ETF as a core strategy, and they are replicating mutual fund or index fund as a satellite strategy. On a different note, few of the investors are taking ETF as a you can say satellite strategy, and the core strategy being the mutual fund. So it depends upon investor to investor, their risk appetite and their objective of investing, basis on which investor can choose whether he wants to make it as a core strategy or a tactical strategy. Now the question comes how ETF works. That's really important to understand, because as I said, so what is ETF? ETF is basically a product which is created on the basis of the underlying index or underlying securities. So there are four important participants, four important parties which plays a very crucial role in ETF, which starts from an index developers like NSE and BSE in India, then the AMC, which is us, and the authorized participant and the exchanges. So index developer basically develops the index like Nifty 50 index, BSE Sensex index, or Nifty Pharma index, Nifty Bank index. These are the indices which are created by NSE, in some cases BSE. Then on basis of those indices, AMC launches the ETF. The objective of ETF is to replicate those underlying index, where whatever percentage that ETF has, whatever percentage the index has in terms of individual stocks, similar kind of weightage AMC will also have into that ETF. And then comes the authorized participant. There was a question that which ETF should we consider and how to consider that ETF to buy or not. The authorized participant is a very critical you can say entity here, where investor or trader or advisors like you should also always consider, because authorized participant is no one but the entity which provides the constant liquidity on the exchange, which makes sure that whenever you as an investor comes on the exchange, want to buy or sell 1 unit or thousands or lakhs of unit of that ETF, the authorized participant will make sure that you get that sort of liquidity on the exchange, and you can buy and sell your desired quantity on the exchange. And then the exchanges are something which we all know, NSE, BSE, where you can buy and sell your ETF based on that. As I said, ETF is basically a replication of the underlying index. Here we have given you example of Nifty 50 value, 20 index composition, and if we create an ETF basis on that index, how that ETF will look like. You can see here Bajaj Auto in this index is 2.49, the ETF, it will be around 2.48%. So if you look at across all the names, the ETF, when we create an ETF unit based on this index, this is how that ETF unit will look like. So in this case, you will see majorly in all the cases, the ETF has replicated the underlying index or the stocks to the similar percentage which they hold into their parent index. So that is where the ETF is being created, and then this is basically what you can see is the 1 unit. So this 1 unit you can buy or sell. If you buy, say now, say for example, the price of this ETF we decide say 50 rupees. So if you want to buy 1 unit in 50 rupees, so your 50 rupees will be divided among all these stocks into this kind of this percentage, which is already there on the underlying or you can say the parent index. So this is how the ETF works. There are two ways to transact into ETF. One way which we all are aware is through exchange, the way you buy and sell your stocks on exchange. Similar way you can buy and sell on the exchange, the ETF also. The other way of doing it transacting through AMC, where you can, the way you buy and sell MF, investor can directly come to the AMC and can buy and sell with the AMC also. But there is one caveat here is that if you really want to buy and sell through AMC, then you have to buy into lot size. So lot size is basically for every ETF, there is a minimum quantity of number of units has been decided, which investor has to buy and sell if he or she wants to trade or transact with AMC directly. So say in Nifty 50 ETF, if somebody wants to buy AMC with AMC, he or she has to buy at minimum 50,000 units of that ETF, then only he is eligible to go to the AMC, else he can go to the exchange and buy and sell the whatever quantity they want to buy and sell. So these are practically two ways to transact. right? So this is the basically the basic things, how ETF works, what is ETF. Now we'll quickly cover the types of ETF. There is n number of n number of ETF types are there. And when we talk about innovation, the innovation is something which you can find here on ETF only. There are different type of ETFs in the market: equity ETF, gilt, bond, liquid ETF, money market ETF, gold based ETF, currency based ETF, also derivative based ETF, multi asset ETFs. You will find based on a broader market ETF like market cap based Nifty 50, next 50, mid cap. These are market cap based ETF. There are sectoral ETF also, like banking ETF, pharma ETF, or maybe healthcare or consumption. These are the sectors. And now there are thematic ETFs also, like ESG, which is a very strong theme and upcoming thing, where investors are now more keen about ESG, which is environment, social, and governance based companies. That's a theme. You will see Sharia is again a theme, keeping investors in mind, which really want to invest into Sharia based funds. So there are ETF based on that. There are other ETFs also. There are different themes in the market, like work from home, cloud computing, EV, electric vehicle. So these are the themes which are playing very important role globally. But in India now, slowly and gradually, these themes are coming in India also. As I said, globally there are other country ETF. You can invest into USA, you can invest into Germany, Japan, emerging markets. So you will find country-based ETF also in some of the country in India also. Lately, we have seen US-based or foreign country-based ETFs are coming up, and now you can buying those ETFs. You can take exposure into US market also. The regional ETFs are there, dividend yield, quality. So there are, as I said, there are n number of ETFs are there, which based on strategy, which based on smart beta. And going ahead, as the market evolves, you will see more and more innovative product, more and more innovative ETFs based on, or products based on ETF platforms. You will witness, and that's where the innovation thing, and that's where the market evolves from an ETF perspective. Now we'll quickly talk about why ETF and how that ETF is shaping globally. So this is a global trend which I'm talking about. This data we have taken from 2005 till 2021 July. As we speak, as on 31st July, the global ETF AUM has crossed 9 trillion mark, and 9.4 trillion is the current status if you talk about global ETF in investing. If you look at the trend here from 2010 till where the ETF, where the AUM was 1 trillion, has moved to 9 trillion in last 10 years, 11 years. And that's where the trend is shaping up globally, and investors are more and more keen on these ETFs. The similar trends, now let's talk about India, how it is shaping up. This is the trend in India. Before 2014, the ETF was known as a gold ETF only, because that was the only product available in the market. Investor used to take ETF gold exposure through ETFs. But in the budget of 2014, government allowed EPFO, which is Employee Provident Fund Organization, to invest their surplus money, or their advised money by the government in terms of percentage, which they can take exposure into direct equities. That some percentage government allowed EPFO to invest into ETFs also. From 2014 onwards, you can see the trend has happened from 11,000 crore AUM. Right now in India, the ETF AUM is at 3,30,000 crore, which is a very big number if we talk about from a AUM perspective. Though again, it is you can say around majority would be around from EPFO, but still out of this 3,30,000 crore, close to 80,000 crore should be somewhere around 80,000 crore should be of a non-EPF or non-government money, which means the money which belongs to a retail investor like you, me, institutional investor, HNIs, ultra HNIs. Similarly, the equity percentage allocation is also going up among the entire EPF, entire equity market. Now, if you look at this is a very interesting slide which shows you how the trend is moving up. If you look at the corporates, June 2015, there were only 6,000 folios. It means there were only 6,000 investors who invested into ETF. But that number from corporate perspective has moved to 41,000, which is around 253% kind of growth. If you look at high net worth individual, which is HNIs, from 4,000 folios, now that number has reached to close to 1 lakh. It means there are 1 lakh investors who are right now investing or participating into ETFs in India based or some global ETF. Overall retail, if you look at, the retail has moved from 2 lakh folios to 52 lakh 41,000 investors, which is around as compared to 2019, which is around 512% growth. And this growth happened during this COVID time also. If you see the kind of demat account got opened, because the ETF is something which provides you ease of transacting also. Unlike mutual fund where you need to fill up a form, submit it to the AMC, here you can do on just a click of a button the way you do trades in your stock. So that's where that ease of doing investment, here it clearly evident that from a corporate to ultra HNIs to HNIs to retail, everybody is now participating in this number, and that's a huge number if we talk about from that perspective. Now, what is the need? Okay, ease of transaction is okay, but what is the need? Why investor want to move out of a existing mutual fund to a ETF, which is again they need to open a demat account and everything? Because of this reason, because India is known for alpha. When I talk about alpha, I'm talking about the returns which your underlying index or underlying, like say in case of a large cap fund, the underlying in Nifty 50, 100 as an benchmark. So the investor understand or thinks that my large cap fund should outperform the Nifty 100 or Nifty 50, which is the benchmark of that mutual fund. But if you look at this data, this is not happening. In last 5 year, 3 year and 1 year time frame, if you look at 3 year, 77% large cap funds are there who were not able to beat their benchmarks. It means investors paying 2% more than 2% of the expense ratio to the fund manager, and the fund manager in return is not able to beat that benchmark, is something which is clearly quite evident. And the margin, if you look at, it's also quite evident. If you now talk about the alpha, in initial 10 years, the normal large cap fund used to give 12.8% on an average returns over and above the benchmark. But that on an average return in last 10 years, which is 2011 till 2020, has shrunk to 2.5%. It means that the market is becoming more and more mature, and because of markets are becoming mature, the average alpha or average additional alpha which you talk about has slowly and gradually is coming down, and because of which investors are more keen towards buying ETFs. So there is a difference. There are returns depend upon fund management style which you get from mutual fund. Then there is an index return, and then there is an ETF return. Now, why? As I said, because right now I was talking about that ETFs, a stated objective is to give index return, but then why I kept ETF return separate here? Because what I'm saying is, if you look at the average alpha generation happens, and that's the possibility here in ETF. If you time the market, or if you do the trading into ETF, that also happens. And because of which, for your investor, for yourself, you can generate additional alpha also, which is not available in rest of the say in case of mutual fund and index fund. This is the data which is very interesting. This data we have taken from January 18 till January 20, how the trader can get benefited out of ETF. If you look at this data says that 68 instances out of 555 instances, the market has closed more than 1% higher than day's low. And that is where traders like you or anybody investor who wants to invest into ETF as a trader can make that extra additional alpha here, because they can time the market. Similarly, if we broaden this data from 2020-21 also, last 1 year, if you look at, there have been instances when the market volatility was there, and because of which in ETFs also, because of its you can say objective, or its ease of transacting on a live basis, you can benefit out of this movement through doing active trading into the ETFs also. Now, this is about ETFs. Now, I'll quickly talk about for the organization I'm coming from, why you should consider Mirae Asset, why Mirae Asset is more keen on passive, because as you were talking about that Mirae, you all know, you all have invested into Mirae Asset fund. The active side of the Mirae Asset funds have been doing very well, which is the normal mutual fund. But we started doing this business also, the passive side, basically the ETF. Why we are doing that? Quickly talk about the group in a very limited time. The group overview, if you look at Mirae Asset, is a financial group based out of South Korea. In 1997, this group got established and from, or you'd say founded on, from that year till now, we are into global investment management, we are into securities, we are into life insurance and other affiliates also. Currently, as we speak, we are into 15 countries. We are available, having 34 offices, around $554 billion is asset we are managing globally. We have around close to 12,400 employees working for Mirae Asset globally. You can see across the globe, country like USA, Canada, Ireland, UK, China, Korea, Japan, Hong Kong, Vietnam, India, Brazil, Colombia. We have offices across all the countries. Now, if we talk about only the AMC business, out of that $554 billion, the AMC business is close to $215 billion, which you can see the growth here. And that includes the equity, ETFs, fixed income, and all other categories also. Now, the ETF business, we talk about why we're talking about ETF more here, because earlier, which I told you was about the normal business. But if we only talk about only ETF, we are present into 10 countries as of now, where we are doing only ETF. We are launching ETF based product, innovative products, and we are growing that business slowly. You can see we are present in Canada, USA, Ireland, Japan, Korea, Hong Kong, India, Brazil, Vietnam. These are the countries where we are doing our ETF business separately. And with that expertise, we launch unique product in India also, which you have heard about, the FANG Plus. Somebody asked on the chat box that what is MAFANG, FAMAFANG. That's an innovative product launched by us a few months back, and that got a very good, you can say, attraction from the market. On the venture capital side, Mirae Asset is a very big name. We have invested in many names like Ola, Swed, Big Basket as in venture capital also. Overall, as we speak, we are around 73,772 crore is our overall AUM, which include the passive, our AUM growth is around 87% on a year on CAGR basis for last 5 years. We have around 38 lakh plus folios and around close to 683-84 crores of SIP book. So we manage around 4,400 crores of offshore advisory also. In India, we are into Mirae Asset Mutual Fund. We have our capital market, we have our venture capital, and we have our financial services arm also. These are 4 companies which are already functional in India under the Mirae Asset brand. Now, this is the trend. If you can see, the trend has been upwards, and we are the fastest growing AMC in India for last many years. Now, in India, if you talk about only passive, the passive business is around close to 2,057 crore, which includes the FF AUM also. We are passive side. We are managing a passive business out of 10 countries, around 330 ETFs, managing around $66 billion of AUM. So that is what our stature right now from a passive investment perspective. Number of investors, if you look at, have been growing with us. We started the year as a 12,000 investors. Now, right now, as we speak, we have around close to 130,000 investors investing into our ETFs as well as our other passive products. So that's where our growth is. Now, this is about the company. We talked about ETF. I hope you understood what ETF is, how it works. Now, I'll quickly talk about why we should consider Mirae Asset, why it is different, because in this session, I think I'll be answering most of your questions which are there already there in your mind. When we talk about ETF, there are a few things which we can understand, which we should understand. Keep in mind is the first thing is the liquidity, because the liquidity is something which is very important for ETF. Because what happens in stock, whenever you go buy or sell on exchange, you want to buy, you need somebody as a seller to be there. Similarly, in case of selling also. Similar case in ETF, the market maker is somebody who is the person who will be standing with buy and sell quotes on the exchange whenever you want to buy and sell. Now, how this liquidity problem is important, or how we are addressing it, why we are different. See, now please understand this is really important. As I said, the market maker. So market maker is a third party entity, which is generally a broking firm, which has their broking license. They do market making for the AMC, and they have 2 important jobs to do. One is to provide liquidity, which I said, provide the buy and sell quote on the exchange. The second is to make sure that the ETF is replicating the underlying index closely or mirroring it very closely. How they do it? First, the market maker, what they does, they generally buy units from the AMC or the basket size from the AMC, where they invest some capital, and that basket size they keep units they keep into their books as a market maker, and then market opens, they provide those units on sell in the market, and similarly for buying also. Then investor like you comes and or anybody comes who want to buy, the market maker will provide the units which he already has into their account, which they bought from the AMC. Similarly, if you are selling, the market maker will buy it, and market maker will redeem those units in basket size with the AMC. So basically, it's a mediator between AMC and the investor who provides the liquidity on the exchange. So what happens then? Now that happens, you know that exchange is an open architecture where investor can come and go, and investor can quote whatever price they want to. To give an example, say right now we are one ETF is trading at say 100 rupees, the Nifty 50, and the Nifty 50 on that particular day is up by say 10%. Just hypothetically. So that 110 rupees ETF should be trading at 100 rupees ETF should be trading at 110 rupees, because the index is up by 10%. ETF has to replicate, the ETF should also be up by 10%, right? Now, say there are two scenarios. One scenario where the market maker is not there. So what will happen? There is a 100 rupees ETF which is trading on the exchange. Markets are up by 10%. You as an investor want to sell, and you put a sell order at 120 rupees. Just because it's an open architecture, you can quote whatever price you want. You quoted a price of 115, say, for understanding. Now I am as an investor want to buy that ETF only. So I put a market order that I want to buy 1000 units. So what will happen? That 115 rupees trade will get executed. So my ETF on all practical purposes will be 15% high, whereas the market is only high positive by 10%. Now, because there is no market maker, whatever price you quoted, I placed a market order, the transaction got executed, and I took that units into my account and done. But the tracking error of that ETF went up because there's a trade happened which was not required. Now, scenario 2, where the market maker is there. So what will happen? Let's take the similar example. 100 rupees ETF should be 110. There's an investor who want to sell 150. Now the market maker is there, and market maker knows that the 100 rupees, the ETF price, the current price of the ETF should be 110. So what market maker will do? Market maker will put a sell order or a sell order at 110. So that when I as an investor put a market order to buy, the market maker's order will get executed, because as per you understand better than me that as per the architecture or the you can say structure of the NSE and BSE, the cheapest price get executed first. So whatever price you have quoted, the market maker will quote the price which is the near to the ETF, near to the benchmark. So that 110 will get executed. So the market and ETF are on the similar lines. So that's where the market maker comes into picture. So this market maker in India, where are close to 17, 18 ETF providers are there, everybody has a market maker which is a third party, which is not their own in-house party. So having a third party as a market maker, you cannot control much to that AP or the market maker. But in my case, in case of Mirae Asset, that market maker is our in-house entity, which is Mirae Asset Capital Market, and we are the only one in Indian market who has their own market maker. The market maker which is owned by us, so we can control him, and we can make sure that the liquidity should be provided all the time. Please remember, market maker can stop doing market making if he feels that the market is highly volatile, because he also has to hedge their position. If he is not able to do it, he has all the rights to stop, because there is no agreement between AMC and the market maker where he has to do the market making all the time. But in my case, because the market maker is my own, so I can assure you that liquidity situation will be addressed at any given point of time, because the market maker is available and it's my own entity. They will provide the market making at whatever happens in the market. So that's one thing. Second is the spread part. This is also important thing. Now market maker coming there, providing liquidity, infusing the capital, buying units in advance. How will they earn? They will earn from the spread. So what spread they charge? The spread they charge between 20 to 50 basis point. You go to the exchange, you want to buy, there is an INF, which I explained, which is naked portfolio value, indicative net asset value. Then there is a spread, which is the basically the charges or the margin of this market maker, which he charges on the INF, and then he quote the price on the exchange. And that charge is being, you can say, charged to the investor only. In my case, because my market maker is my own, we don't charge any spread. So our spread is zero. Whereas in market, you will see 20 to 30 or 50 basis point kind of spread is being charged by the market makers to the investor. So in my case, that spread is also not there. That is also very important thing, and that you can see the investors are coming more and more towards us because of those two important reasons. A third is a dedicated ETF team. We have our own in-house team, separate team, which is starting from a dealer to operation, everybody in the sales team who takes care of the transaction and makes sure that every transaction goes through smoothly. And obviously, after doing all these processes, we provide a very relatively low cost products on the market. On an average Nifty 50, you will get at 10 basis point or 12 basis point as a TER, which is the expense ratio. In my case, my Nifty 50 is around 7 to 8 basis point. So idea is to provide more and more you can say cheap products. So this is what I was talking about. I think I was just simply giving that example of 100 rupees, 110, 150. This is a live example which happened last year in the month of March, when actually COVID outbreak happened. First time news came out and market were down. If you look at here, I'll just quickly brief you. These are basically Nifty 50 based ETF. We can't name them because of compliance reasons, but if you look at what we have done is we have arranged them in a manner of you can say on the basis of their AUM, right? So we have arranged them in descending order. The A is the largest ETF based on Nifty 50 in terms of AUM, whereas B and C, so on and so forth. What we have done is we have taken few dates of month of March, where you can see, say on example, say the 16th of March. Or on the 16th of March, market, which is Nifty 50, was down by 7.61%, which you can see here, right? 7.61%. If you look at the largest ETF of India on that particular day, when the index was down, that ETF was positive by 2%. Similarly, here look at on say 24th March, index was merely positive by 3%, but that largest ETF was positive by 13%. The second largest was positive by 10%. Here is the 10%, 34%. This is what I was talking about. What it shows that market makers were not available during that particular day because market were volatile, or there may be a number of reasons. But if you look at me on that particular day, the Mirae Asset ETF across the time frame, we have replicated the index to the T, and that's why my correlation with the index is 1. And that is where having a strong market maker always gives you that comfort. And that's why, to answer that question, please look at the liquidity situation of that ETF and how strong that market maker is, basis on which you can choose the ETF, because these situations can occur again also, because the way Indian market is shaped, that can happen. There may be some news and there may be some other this sort of situations comes in. So this is INAV. Unlike other AMCs, what we have done is we have provided INAV on the exchange, on our website, where investor can go and himself can decide and choose the INAV, and can check the INAV of my various ETFs. And basis on that, he can simply put the construction cost in it, and he can check that the similar price is being quoted on the exchange. This also gives you confidence and proves my point where I said that we are not charging any spread. So that's also an important thing which we have done on our website also. We have few products, we have few India-based centric products, we have few global products also. The Nifty 50 is a base product which replicates the Nifty 50 index. The second is Nifty Next 50, which replicates the Nifty Next 50 index. The third is ESG, which is Environment, Social and Governance based ETF, which is India's first ETF based on ESG, one ETF platform for ESG. And there is a NYSE FANG Plus ETF, again India's first ETF based on NYSE Fan Plus Index, where investor can take exposure into USA-based top tech giants like Facebook, Google, Netflix, Tesla, Twitter. These are the companies which are already day to day are part of our lives, and there where you can own them also. Similarly, we launched a Nifty Financial Services ETF, again India's first ETF based on BFSI sector, because right now, as of now, there are ETFs based on Bank Nifty only, and this is India's first ETF which includes other than banks, other companies also, sectors also, like your AMC business, life insurance, general insurance, right, your NBFC. So all put together is a banking and financial services index. So this is the product on now. Recently, we are launching from Wednesday, which is Mirae Asset S&P 500 Nifty, top 50 ETF, which is again India's first ETF based on S&P 500 top 50 index. Right. So these are the products which are there. I'll just quickly take you through. I'll not take much of time. The Nifty 50, as you all know, it is based on Nifty 50 index, where you can take exposure into Nifty 50 based companies on a similar percentage which you can see on the index also. Here we have given you the comparison. The Nifty 50 ETF is 26% bank, 16% IT, 12% crude oil, 10% finance. So the similar exposure you can get into that ETF also. The Nifty 50 is an ETF which is listed on NSE and BSE, both the index. NSE, the ticker is MAN 50 ETF, and BSE it is 542131, which is mentioned there. There are three authorized participants, but my key authorized participant is Mirae Asset Capital Market, which is our own subsidiary. ETF unit size, as I said, if you want to buy to ETF to AMC directly, the minimum number of units you want to buy, you have to buy 50,000. There's expense ratio 8. So this is the products which you can look at. The second is Next 50. Next 50 is nothing but the 51st company of the index, 200th company. So the next 50 companies of the Nifty index are basically part of that index, on basis of which we have launched the Nifty 50, Nifty Next 50 index also. You can see it's a very well diversified sector where index where you can get exposure into consumer goods, financial services, which is highly, you can say, exposed to Nifty financials and Nifty 50 index, is 37%. But here you will get only 17% exposure. But you will get exposure into pharma, you will get exposure to metals, which is not available, power, which is not available with Nifty 50. Similarly with consumer goods. So it's a more diversified index where you can get exposure into next 50 companies, which are going to or poised to become the top 50 companies in coming years, and then you can take that exposure. It's a basically exposure of large cap and mid cap, a pinch of mid cap, and then you can make it more. Again, this ETF is listed on both the indices, Nifty 50, NSE and BSE. Then the ESG sector leader. This is India's first, as I said, ESG index. For that, we created a separate index, which is sector leader index. So first we created that index, and then we launched this ETF fund. What we have seen initially, lately, the investment strategy has to be, traditional in investing has to be to analyze the basis based on financial parameters and then focus on the profitability. That used to be the main concept or main way of looking at investing. But now how this is changing, this is shifting to here. This is shifting to a sustainable investing from a traditional investing, where you will analyze the based on financial parameters, plus also you will look at the focus on environmental, social and governance part of that company. Also, while focusing on the profitability, investors are focusing on the sustainable business model also, how sustainable that business model is, how longer, because when we invest for years. So for that perspective, how long we can look at this index or this particular company, this is where the shift is moving. So this is basically a theme where the companies which are not doing well on these three parameters, environment, social and governance, are basically excluded from the index, from the ETF, and then we created a separate index, and then we compared those companies with their peers globally also, how they are faring in terms of ranking. So ranking will be based on these three parameters. We have seen lately so many examples in India also in 2013, 18, where because of governance issue, because of environment issue, many companies were into in news. So that's where now this is also something which we created. This product is very good and it's a long lasting product. You should invest and you should look at this because this is going to be the future. Every investor will talk about ESG in going at globally. This industry is huge. In India also, we can expect more to happen. I'll quickly talk about the Fang Plus, which is our last offering few months back, which got a lot of traction in the market. This is an index which ETF, which invest into Facebook, Amazon, Apple, Netflix, Google, Tesla, Twitter, Nvidia, Alibaba, and Baidu. These are the companies where this ETF invest into. It's an equal weight index where 10% exposure will be given to all those 10 companies. Basically, the companies whom you are using in your day-to-day life, now you can own them also. So that's where the idea is to look at e-commerce, internet surfing, streaming, gaming, social media, cybersecurity, cloud computing, electric vehicle, which is a big theme, right? Industrial automation. These are the things which are part of this ETF, and that's where investors are more keen to be part of this journey, because this is where the future looks like. And if you look at the future, where you will see artificial intelligence, where you will see driverless cars, where you want to see electric vehicle, these are the companies who can take you to that future. And that's why we created this index and investing into these big giants where the overall market cap is around close to 9 trillion, revenues 1.09 trillion. These are the huge numbers which are like far beyond that what India as a country right now doing, because obviously India is a growing country, so it will reach to that level, but you take time. But now these companies itself are too huge. These are the giants where you should always look at from that perspective. This ETF is also listed on NSE and BSE both. This ETF basically invest whatever you invest is getting invested into directly into US market, and we buy those 10 companies on behalf of the investor. Now we launch Financial Services ETF. This is again, as I said, a broad-based index. Then the only bank Nifty, where you include capital market, insurance companies, NBFCs. So it's a far bigger index than the normal bank Nifty. We have compared here. If you look at Bank Nifty, Nifty 50 and financial services from 2004 till date, you can see that financial services has outperformed lately all the two indices. Now we have seen more and more IPOs are coming. We are hearing about LIC will be listed, Paytm will get listed. Those companies will be part of this index, not the bank Nifty. And that is where this index, because more and more tech companies, more and more fintech companies are getting listed, they will become part of this index, and that's where the number of companies will become higher there. From keeping that in mind, we launched this index, and that's also getting a lot of exposure, a lot of traction in the market. Evolved investors are more keen on this particular ETF. That is also listed on both the indices, NSE and BSE. You can buy and sell through exchanges also. Now this is my last offering. This is the product which we are launching from 1st of September. Again, another step to invest into USA, because when you talk about taking exposure into USA, there are two ways. One is the tech-based exposure, which I talk about, Fang Plus. The second is a more diversified way of getting exposure, because when we invest, when a new investor comes into India and want to invest, we advise him to invest into Nifty 50 or Next 50 or 100, because of keeping in mind that your overall, as an investor, you should look at from a liquidity perspective, from a you can say there are a number of things, because the companies are bigger, highly liquid, there is less risk. So keeping that thing in mind, if you as an investor want to go out of India, want to invest, or in a country like USA, then you should also look at the top 50 companies of USA. These top 50 companies are basically caretakers of 40% of MSCI World Index. These are the giants, and you can say a sector agnostic index, which is like, unlike FANG, where you'll find only tech. Here you will find consumer discretionary, healthcare, power, your IT, communication services, consumer discretionary, all these sectors are there. And this is a more diversified index, which includes 50 companies, which is like Microsoft, Alphabet, you can say McDonald's, P&G, Johnson & Johnson, Visa, Microsoft, These are the companies which we are buying, which we'll be buying for investors, whoever invest into this index. This in ETF is again will be listed on both the indices. This is NFO period will be from 1st September till 14th September. This is on an ETF platform. You can directly buy with the AMC, and then the listing will happen. So listing is supposed to be happen after say 5-6 days of 20th September, because that's how it will happen. So the allotment will happen on 20th September. So this is where we were talking about, and I thought so I'll pause here. If there is any questions, anything we can take now.
Yes, yeah, thank you so much, Umesh. It's a good session what we had. I mean, a lot of insightful presentation you have done regarding different points, right? So we already got several questions. In fact, I was to interrupt in between, but anyway, we'll take it in that's right. So we have some questions. So I'll take it from Mr. Amit. Amit is asking, what is the advantage of investing on a particular ETF compared to investing directly into a stock or invest in a small case. Small case, I hope you are aware of, right? So
Yeah,
investing into a
yeah.
small case which have a same set of stocks is asking. So I'll ask
Yeah.
the question once again. What is the advantage of investing a particular ETF comparing to invest directly to a stocks portfolio you can make on a small case or something similar to that, right?
Yeah, so what happens? The small case is I would like to answer the small case thing first, because the small case is basically nothing but a platform which basically do the bundling, do the bundle up, and then they provide that particular bundle to the investor. So basically, you're buying stocks only directly. So ETF is basically an index tracking mutual fund, which you can buy and sell on the stock exchange. It's especially appearing, appealing to the investors or traders who want to take an exposure or want to take a call on a specific segment or a sector rather than taking on a specific stock. Like if somebody has a view, want to buy say BFSI, so rather than buying different stocks of BFSI, by ETF you can buy the entire index, and you can get the benefit out of that, which is basically gives you more diversification as compared to, because when you buy a stock, you will buy 1 or 2 stocks or 3 stocks. Here you are buying the entire index, which gives you more diversification. So from a risk perspective, this helps. So that is the basic difference between the ETF selling or ETF buying or a normal stock investing.
Okay, got it. Yeah. So next question is from Arjun. Okay, he's actually a new customer. I mean, he's actually a new to investing. So he's at his 20s. So he want to invest. So he's actually an NRI now. So he want to invest into market. So can you suggest which was the way on regarding with ETF, which will be the no first trying ETF should be or something?
So yeah, so as I said, that ETF, whenever a new investor enters into any sort of investment, be it mutual fund or an ETF, the suggestion would be suggested ETF would be a large cap based ETF, because that's where he or she can get some exposure or some understanding of the ETF, and then as the time evolves, as the investor get evolved, then automatically he and she can take exposure into other ETFs also. So from a India perspective, he should look at Nifty 50 or Nifty Next 50. But from a global perspective, he should look at this S&P Top 50 sort of ETF, which gives exposure into a wider universe or into large cap companies.
Okay. So I can see a lot of question regarding the index funds and ETF. Okay. So say looking towards the liquidity side and say for the time horizon, can you comment on something on the which customer should take say ETF and which customer will be better on the index side?
See what happens now whenever we talk about say investment horizon and all. So index is a good, as I said, index and ETF has some similarities, like both are replicating the underlying index, and then the kind of exposure you get in both the cases. But in ETF, you get the live trading option, which you can't get into index fund. Point number one. Point number two, obviously, the expense ratio of also on a normal, you can say indices or normal large cap indices or other indices, the index fund will be little costlier than the ETF in most of the cases. And the third is the costing part also from other perspective, because whenever you buying selling, because there's a unique feature of ETF, which is like, unlike mutual fund, when an investor buys and sell in MF, like if I'm buying and selling, so that AMC has to sell or buy those units from the market, and there is some cost attached to it, broking costs, STT, stamp duty, and other things. Or if it's a global fund, then there's a custodian charges also, which is too high. So that get distributed among all the investors in case of index. Similar ways, the way it happens in case of mutual fund. But here in case of ETF, that cost will be you can say levied to the person or to the investor who is doing the transaction. Like in ETF, if I am buying, whatever charges are there in that ETF, all the charges will be levied to me only, rather than in case of index, it will be levied to all of the investor. Whether I'm buying or not, I will also be part, because that get adjusted into NAV. Here, this is not the case, and that's for a longer investor who want to stay investor for a longer time frame. That percentage of expense become huge. So always investor who want to take a global exposure and he want to think that I want something which is cheaper, then the ETF will score a little higher there because of this costing or this expense issue. So that is something which an investor always should keep in mind.
Okay. So to attach to the same thing, so we have one message from the customer that say someone who is looking for a short-term perspective, better to be in in ETF who can trade, and who is looking for a longer term, you can look for the index fund. Some comments. Okay. So what is your take on that?
See, as I said, if there is an index where you are not able to find any ETF on that index, then you should look at that index. Always compare the expense ratio of it, and while comparing expense ratio, keep that thing in mind. If there is an ETF available on that index concept, which is a theme where you are going to launch that, choose the index, you can also explore that ETF also. But if on the cost parameter, the both are similar, then you can choose index also. But as I said, the expense ratio is something, the longer you stay, the longer it will become higher, because in index and in MF, every day there will be transaction happening, buying and selling. But in ETF, if you all do only do, then only that expense will be charged to you. But as I said, if the product is not available on ETF platform, you should consider index. If that is there, then you should go for ETF.
Okay. So we have next question from Jasil Muhammad. So he's asking, say when he opens the chart of gold base ETF, there is many faults regarding. I mean, there is a huge moment in a day. When he opens the chart, he can see 5% move and 2% move in an ETF. So why it happens? He's asking.
So, as I said, no, it's completely whatever trends, whatever movement you see in an index or in an ETF on, that's primarily primarily is the market makers role also into that, because and in case of gold, obviously you have to buy physical gold also. That is somewhere that logic also comes in, but primarily it is with the market makers role in that particular ETF, how he or that particular AP is managing, because the trade happens, everything will be controlled by him. So that is where you will see some of the, or maybe some bulk deal happens on a specific particular time frame, and then what happens, the market maker is going to quote something. He has put in, say, 1 lakh unit on the exchange, and those unit got exhausted. Then market maker has to replenish it, and the replenishment takes 2-3 or say 30 second or say 1 minute. During that 30-second 1 minute time, there is highly you can say possibility that other trades will get executed. Then you will see the chart will go up, and then again the market maker comes in, he will control the price. So that is how it happens. So that is also can be one reason where we can say you see some fluctuations during the day.
So you are saying there should be a good market maker, otherwise we can see these kind of fluctuations, right?
Yeah, the market maker is important, but fluctuation sometimes comes on a news based also. So it's not like always like that you have to look at from market maker perspective also, but sometime you will see initial jump happens within the market, within the daytime, because of some news or something related to that particular asset class.
Okay.
But yeah, market maker is a very important element for this, for ETF.
Yeah. So we have another question from Kevin. So he's an NRA. So you want to know regarding the taxation side. I mean, how the taxation work for him, any issue regarding. So on that side, I also like to you need to comment a few on the taxation part also, generally.
Yeah. So what happens, like on an ETF, which is listed on Indian exchanges or Indian ETF, the taxation will be as good as the equity taxation. The moment you go out of India, the taxation will be debt taxation, where the long-term capital gain, short-term capital gain comes in. So in a global investment perspective, the if investor stays more than say 3 years, then the long-term capital gain comes in, where the 20% taxation with the indexation benefit he can avail. And if investors moves out of that investment before 3 years, then it will be short-term capital gain, and which will be charged as per his or her tax bracket he or she falls into. In India, the ETF taxation will be as good as a normal equity taxation with all normal long-term and short-term capital. Or in case of NRI, obviously there will be some tedious element to it that can be checked with their advisor on a fund basis.
Okay. So we have another question from Arfaz. So he's asking regarding the tracking error. What is exactly tracking error? So can you say on that? I want to attach a question. What are the points, key points that as an investor I need to check before investing into an ETF?
So the tracking error is, simply put, it's how well the ETF NAV is tracking the movement of the index, which I told you, the market maker and the stated objective of the ETF is to replicate the underlying index. So how that ETF's NAV is replicating that underlying index is something on a daily basis. Okay, so that is how it becomes that's what the tracking error is. And lower the tracking error, better the ETF. So you should consider that industry average on that particular fund tracking error, because the tracking error differs on a category to category. In a large cap fund, you will find lesser tracking error. In a mid cap or in a thematic fund, you will see little higher tracking error. And if you go to a global fund, global ETF, you will see the tracking error will be little more higher, because the more you can say curated or exotic products you comes in, you launch or you operate with, there will be little bit tracking error on a higher side. So lesser the tracking error, you should always look at before. Also, apart from tracking error, you should consider the tracking difference also, because tracking error is what? Tracking error is basically the standard deviation of the tracking difference. But the tracking difference is basically, to put in a layman terms, is basically the difference between your ETF returns versus the index return on a daily basis, on a layman. So the tracking difference gives more clarity as an investor than the tracking error. But tracking error is something which is more popular. That's why people talk about more about tracking.
So any other points that as
That's one. That's one. The second is the liquidity, as I said, is really important. Third is the track record of that ETF, how confident the AMC is, how confident they have been, confidently or in what fashion they are managing rest of their ETFs. And these are the basic things which they should investors should look at from while investing into any ETF.
Okay.
And obviously the costing part.
Yeah, the expense ratio, right?
The expense ratio.
Yeah. So another question from Nitish. So do we get dividend benefits in ETF?
That's a really interesting question. So what happens? Historically, ETFs are not generally, they don't declare dividend, and the dividends basically are reinvested into that ETF itself. But lately, we have seen a few of the AMCs declared dividend into Nifty 50, into their Nifty 50 or Sensex ETFs. Primarily, the EPFO or the Employee Provident Fund organization wanted that dividend to be declared, because they wanted to give it back to the investors, their investors. That's why. So the dividend generally, because what happens whenever we declare dividend, it get taxable in the hands of an investor. So historically, ETFs generally don't, though they can declare, but generally, if you look at the history, they generally don't declare. So whatever dividend proceeds they receive from the underlying stocks, that get reinvested into that ETF itself from the in percentage allocation in terms of the stocks.
So basically, whatever the dividend declared by the companies, that benefit we are getting as an investor, right?
Yeah. Obviously, the declared dividend benefit the ETF will get, but it will not be declared the way you get into mutual fund or generally it doesn't happen.
Okay. So next question from Justin. He's asking, what is the difference between Mirae 50 ETF and Nifty piece? Or
There is no difference. So both the indices, both the ETFs are replicating the same index, which is Nifty 50. In that case, also they are replicating Nifty 50. So the Nifty Bs and Man 50 ETF, which is Mirae Asset 50 ETF, are similar. There will be some differences in terms of costing, as I said, the market maker, strength of the market maker, and the volume. So hardly any difference. The only difference will be of the process, because unlike mutual fund, in ETF, on return perspective, you won't see any big difference, because both have the mandate to replicate the index. If index is given certain percentage of return, similarly the ETF has to give that sort of return, some basis point here and there. So there's hardly any difference, but the difference can be in terms of tracking error. That the difference can be in terms of tracking difference, in terms of expense, in terms of liquidity.
Okay. So next question from Akash R. He's asking, what is the difference between Fan ETF and Fanfundo?
So there is no difference. So the difference is this way, that the ETF is basically created something where investor can invest, and that money will be deployed in the US market directly. Now the FOF, we created a product where investor who don't have demat and who doesn't want to use their demat can enter into that FANG plus through mutual fund route, where the investment will happen the way it happens into mutual fund. Then the fund of fund will invest that money which you are investing into fund of fund into the ETF. So basically the fund of fund will invest into ETF, and then ETF again the same process. Then ETF will invest into USA. So basically it's another way of investment, another way of investing, or option of investing which you provided to the investor.
So another question from Syed is asking how we can find the tracking difference of Mirae, where we can see that.
You can see these are tracking difference. Everything is available on third-party websites also, and you can go into on those websites, and you can track. If anything is required, you can post it on our website. We will with your email ID and everything, we will provide separately.
Yeah. Okay. And yeah, another question I have seen that someone asking regarding the pledging side. So basically, as I mentioned earlier, mostly we are, or the community, more into the trading side. So for them, actually, this pledging and getting margin for trading is more important. So on that front, what will be your comment? ETF as an instrument.
Yeah, so the ETFs are being used, I think, by the trader community, being used against the margins also, but there is some haircut also. You will find that haircut depending upon what sort of ETF is. Generally, on a broad-based ETF or a large cap based ETF, you will see lesser haircut, but on a thematic or a sector ETF, you will see higher haircut. Like in case of my fund, the Nifty 50, you will see close to 9% haircut, so you can get margin up till 90% of your investment, where in case of ESG and FANG plus, you will get around 20% haircut, so around 80% can be used as a margin. So that is there, but again it depends upon broker to broker. You have to check with your broker or whoever you are doing your trades with, that what sort of margin they are providing on a specific ETF, because it may happen that different broker will have different margin facility on different ETFs. So that can be used, but that's a good way, and I think traders are using it, and that's how the ETF globally is being managed. Traders are doing their active calls, taking their active calls on ETFs through trades.
So on that side, one is asking regarding the Bharat Bond ETF, which is from the Edelweiss, right? So similar way, which will be the better segment? So you have mentioned different kind of categories on the ETF, right? Gold Bs are there, debt funds, and even equity ETFs are there. So which category, as a person, you will be suggesting to be for the trading community?
See, Bharat bond, if you talk about Bharat bond, is a basically a good way, actually a good way to take exposure into known portfolio of high quality PSU, AAA, issuers, right? So it provides basically provides transparency because of residual maturity also, right? It provides indicative yield, which is investor will realize if he or she still stays till the maturity of that particular bond. And in a way, debt ETF will look into alternative FMPs. You can consider or you can replace them as a FMP also. So it is a good way of saying that the debt ETFs are a good way of looking at from a FMP perspective. So as I said, from a margin perspective, brokers are using debt put ETFs also as a margin. So you have to check, the trader has to check with the dealer what sort of margin they are providing on what sort of markets. If you are pretty bullish on equity market, then you should go for equity ETF and country. The debt will be more stable than the normal equity ETF because of the dynamics of the in asset class. So that's where the trader can take their call where they want to go.
Maybe on that side, I want to comment. Maybe if we have a combination, say some debt ETF and some
Yeah.
equity ETF, that might work well for the longer term time horizon, right?
Yeah. So because as I said, if you are bullish on market and you are taking exposure into equity, obviously the market will go up. Your margins will also go up. Similarly, I think you have, as you rightly pointed out, mixture of both of them can always be a right proposition in terms of taking that exposure.
So on that side, Umesh, I have another questions because several times on different sessions what we have discussed, we should have an asset allocation on different kind of
Yes.
right?
Yes. Yes.
So is that possible on ETF? Can we, by
Yes.
investing into ETF, can we make an asset allocation? What do you suggest?
Yeah. It is very much possible, and that asset allocation is something which is the need of the hour, I would say, and it's an elephant in the room which we need to address, and that's really important because now the time has gone when you buy one asset class and you stay invested into it, and then you think that you will get your returns. You may get, but having a more diversified asset allocation point of view, in ETF you get that opportunity quite often, and you will get more options available here because, as I said, the innovation part is here. You might not see an electric vehicle based ETF on active side or a product on active side, but you might see an ETF based on electric vehicle globally. So that is where you can get exposure here. So from an ETF perspective, it become more sense to be more you can say asset allocation centric approach. You can keep, and then you can advise and you can take that exposure.
Okay, good. Yeah. So I actually missed the name. Someone was asking when you are saying about this FANG ETF. Someone was asking on FANG. It seems to be a bit concentrated in the sense 20-25% weight for a single stock seems to be he mentioned, right? So why don't you think that is an overweight
No,
something?
no. So I think I just want to
Joe, right?
correct
Joe
him
for
here.
reference.
Yeah, it's 10% basically. It's a equal weight index. So every ETF, every fund in that index, the 10 stocks are there. Every stock is weighted at 10%. And then the rebalancing happens. So rebalancing happens, keeping in mind that every time when the rebalancing happens, it should be that to make that weight again to 10%. So the quarterly that rebalancing thing has been done. So we also understand, as I said, this is a concentrated call, but concentrated call keeping in mind that these are the top 10 companies who are very big, huge in terms of R&D, in terms of sales, in terms of their numbers, in terms of their growth. And that's why we kept those 10 companies into this index, and we thought that these are the companies which can take you to the future. Similarly, rather than buying S&P 500 as an overall index, we are launching top 50. Again, we are trying to curate 50 companies out of which the top 50 companies where you can invest on a market cap basis. So it's not that much concentrative, but yes, it's a concentrated call. And if you really want to, if your risk appetite doesn't allow you to take such call, then you can look at the other diversified products like S&P 500 top 50 and all.
Yeah, so to add it that 10% we can see even on a mutual fund portfolio.
Yeah, we can see.
So
But the tail is higher there, but here there are only 10 stocks. That's one caveat which comes in.
Okay, well that's it. Say personally, I also getting more interested when you introduce the FANG ETF, and now you're coming up with S&P 500 as well, which is looking quite interesting for me, as I want to take some international exposure. We looking for these kind of ETF because we don't know much about the international stocks in detail, right? So maybe we are not aware of the data points what we have on an international stock. So on that side, it is looking quite good to be getting invested into an international ETF, right? So I want to know more about the FAN as well as the upcoming NFO on S&P 500 regarding the risk factor, what is involved and what is the expected return as a retail investor, how much we can expect for that.
Yeah, so I'll cover the FANG part first. If you look at the FANG has given returns, say in 5 year, FANG has given around 47% return into INR terms. In 3 years, it is around close to 40%, whereas Nifty 50 has given 15%. And 5 year Nifty 50 has given around close to 15% again. So 47% versus 57 is a quite a outperformance in terms of FANG. Similarly, on S&P also, S&P 500 has outperformed Nifty 50 quite a huge margin. Now, if you look at the risk or reward ratio, the risk reward ratio is like the money you invest and what sort of reward you get out of it is in case of FANG is 1.2. Investing 1 rupee, the chances of you getting reward is 1.2, whereas in case of Nifty 50, it is 0.8 on 3 year basis. In case of S&P 500 top 50, the risk reward ratio is 1.1 against 0.8% in case of Nifty 50. So from a risk reward perspective, also from a return perspective, outperformance perspective, these two indices have done pretty well than the Nifty 50 index, which is in India. Obviously, there's a very limited correlation. The correlation between Indian market and US market is 0.16. So it means it's a good call to take a diversified exposure, more you can say exposure from a hedging perspective, because if Indian market doesn't do well, there are very high chances that US market will do well. And that's where if you look at the chart for last 10 years, in last 10 years, there are only 2 instances when India has outperformed the world. 2 times China has done it, and 6 times USA has outperformed the world. And that is where we are trying to say that winners keep on changing. You have to diversify your investment towards your home ground, because India is what? India is around 3% of the GDP of the world. The 95-96% opportunities lying outside India, and that's primarily into USA. So that is where we are launching these 2 products, keeping in mind that the investor should take exposure outside in India, should explore this kind of opportunities where he or she can take exposure into giants and big companies, big names of the world, and can take advantage of it. So these things, all things put together, if you look at the Sharpe ratio also, everything is quite better, much better than the Nifty 50 if you compare. So these are the 2 funds. FAN, if you really want to take exposure into tech giants, you are pretty bullish on tech only, and you can take exposure into FAN. If you want to go a more diversified way of investing, you want to take exposure into other than tech, other big companies also like Johnson & Johnson and MACD of the world and others, Visa and MasterCard, you can take exposure into this S&P 500 top 50 also. Or me as an investor, I would like to take exposure into both of them because both are different. So I'll take say certain percentage allocation. Generally, global investing should be maybe ranging between 5% to 15%, 20% depending upon investors' risk appetite. So whatever percentage I decide, I would like to differentiate, or I would like to allocate among both the funds, because by doing so, I'm covering the entire USA from 2 different angles.
Okay, so we already excess of our time. Even as I added to that question, that one, I just want to have one more question on that. So as a personal view, I mean, if you're looking to a moderate customer on the asset allocation part, how much would you recommend to have an international ETF?
See, international ETF or international exposure per se, right now, if you look at, there are close to 18,000, more than that money is already invested outside India through by Indian investors. So it ranges between 5% to 20%, depend upon investors' risk appetite and how much and the goal also. keeping that in mind, investor can take his call that the percentage, maybe like in my case, I would like to take 20% exposure because that sort of risk appetite I have. But there might be investors who want to take 5% also. So there is a range. The investor can start with 1 or 2%, then slowly, gradually, if he or she is confident, then can increase the exposure to 5, 10, 15%. But ideally, it should be in between 5 to 15%.
Okay. So yeah, so that's it. I mean, we already 1.5 hour session, so it's getting too long. And
Yeah.
so it was a really helpful for everyone. I hope everyone in the community really appreciate the session, because so much insightful talk we had, and even you have answered many of the questions from the customer. And before that, I also want to thank Mr. Akhilesh, who are actively messaging everyone who was on the message. So you might get a reply from Akhilesh. Akhilesh is actually one of Kerala's Mirae team only. So Akhilesh, thank you so much for the reply which you have mentioned. And Umesh, yeah, it's actually an absolute pleasure to me. Thank you so much.
Thank you so much. If we miss any questions from this, maybe Akhilesh will get back on those questions. I'll ask him to, or maybe I'll give from my end also. I understand. Sorry, we can't take all the questions, but thank you so much for your patient hearing. Thank you for for becoming a wonderful audience for this, because this is a new concept, new topic, and for 1.5 hours it itself is a big thing for us. So thank you so much again. Thanks. Thanks to you also for giving me this opportunity to interact.
Okay. So we can wind up the session.
Thank you so much. Thank you.
Thank you. Bye.